Hey you guys, happy Friday. So I promised you that I would tap into this program that everybody is freaking out about and hearing about. And honestly, I've been getting a bunch of DMs. So if it's important to you, it's important for me to educate you about it. So let's kind of dive into that. So first of all, let me just kind of make it clear that the Cal HFA loan, it is not a new loan, you guys. This is not a new program. It's nothing that I don't know about, and it's nothing that if you haven't spoken to your realtor about that you shouldn't have known about. The only difference is the terms that they have right now. So let me kind of explain a little bit of what that means. So previously the terms were that should you qualify for this program, there was a second silent loan that you would have to pay back should you sell the property, no matter what. The difference this time around is that if you're living there for at least 5 years, that silent second loan, technically it's actually being forgiven, which is why when you see it, it says forgiving program, right? So you don't have to pay it back. And in order to qualify for a first-time home buyer, you have to have not purchased a home in the last 3 years. Okay, so that's the gist of it. So now let's kind of get into, okay, that sounds not too bad. Well, how do I qualify for that? So first and foremost, with the Cal HFA loan, you do not get to pick your rate. So as you guys know, the rates are increasing right now, but nonetheless, let's just say that you were fine with that and you were wanting to qualify for a home loan. You cannot shop rates, you cannot buy down your points, you cannot, there's none of that. The program in itself has their own rates, and that's the rate that you get. And the rates are a lot higher, and also too, because of that, which means, as you know, your monthly payment is high as well. So you don't get to choose that either. And what a lot of people don't understand is that the AMI, which is the average, the annual median income for the debt to income ratio, really, that you have to have. So in Orange County, it cannot be more than 80% for for the county. So San Bernardino has our own, LA County has our own. Orange County is what I'm going to focus on, is 80%. And with that amount, it came out to about $68,000 a year that you cannot make more. Okay, and again, I don't want to get too far into it, but if you're married, that could also change as well. Like if you are married and they're including your spouse's income, then forget about it, right? Because to them, you make too much money, even though I get it, like on our scale, it's not enough. So that's another thing. The big catch is this, and I think this is why it really frustrates me. Like, I kind of wish that when you read about this stuff or they show it on TV, that they kind of say something like, hey, by the way, with this information, get in touch with your realtor to make sure it's a good fit for you. Like, they don't say that. They just go like, oh, great news, and kind of give you this kind of like high hope. So the catch is this. With that said, regarding, making X amount per year, regarding that silent loan being forgiven and that rate, what they don't understand is that because of that, what do you actually qualify for? So we did the numbers, and in Orange County, that will get you, so meaning if you were to qualify for that program, mind you, you have to make that certain amount. You can't make more than that, right? Let's say you make the higher end of that lower end amount. You will qualify for like a $420,000 home. You guys, tell me if you have freaking found a home at that price. You guys, like, no. Okay, I have clients right now. I have two clients actually that are looking for studios in Orange County. Studios, okay, meaning not even, there's not even a room. It's like the room is within the whole place, or even a one bedroom. We're shopping at 450, and we're having a really hard time. And they're FHA loans that we're having a really hard time because the houses have already gone up. Even though with the interest rates going up, the prices are still going up slightly because there's still no inventory. That's our freaking problem right now, the inventory. So with that said, tell me where you're going to find that property. And I think that's where it's very deceiving, because that is the catch. You're not going to find anything. So in my opinion, and I'm not shaming this program, it's a great loan if you're gonna buy like something in the 400 range. That's really what it is. Okay, and if that seems like it's a good fit for you, then probably maybe you can reach out to a lender and find out how you can get started in this program. So let's get into the other side of it. Let's say you do qualify for this program and you're buying a condo for 420,000. Granted that you find it out there, let me know. And let's say that does happen. Okay, on the other side, as in, for example, you submit offers with your realtor. One, it is a very difficult loan to get accepted. It's very similar to like the FHA loan. And if you guys know, we talk a lot about why is it that people don't like FHA loans. It's because they, on the side as a listing agent and the seller side, to them it looks like it's a borrower with not a lot of money. And it's not that they're looking down upon them, it's just more that should there be an appraisal issue, anything like that, you don't really have the funds to pay any gaps or anything like that, or you're more than likely to ask for repairs just because of how you don't really have a lot of money to fix it. So a lot of the times they take conventional offers because they just know that those people have more than 20% down. And it's just a better offer. So aside from the program itself and how to qualify for it, not only that, but as a borrower, you don't even look like a very strong borrower. And I hate to say that, but it is the truth. People don't like seeing those offers come in. So with that said, I want you to understand that it could be a good program. It depends. I always say that's usually my answer. It depends. But if you feel like it's a good fit for you, I highly recommend reaching out to a lender. And just be mindful, it does take a little while because just like the way you're seeing it on the social media, so is everybody else. So everyone else is going to try to jump on it. So the approval time frame honestly is about 2 to 3 months sometimes. And then even then, in order to get your offer accepted, you're looking like at a 45-day, 50-day escrow timeline. So all in all, to say, it depends. Do I think it's a good idea? I would probably rather my clients do a 3.5% down loan with an interest rate that they can shop around for, and an interest rate that could probably buy down points, and just keep yourself in a normal, market with everyone else. It's really not that much. I've seen clients only have to bring in like $15,000 down. I know that not everybody has that, but I do feel there's other options. So that is the gist of it. But just remember, it is not a brand new program. It's been around for a very long time. It's just something that you haven't heard of. And remember, elections are coming up in November. So just be very mindful, be open your mind that you're going to be seeing a lot of things on the media that will encourage your way of thinking, that will persuade you to push a certain way. That's just what it is. So at the end of the day, reach out to someone you trust, reach out to someone who does on a daily basis, and I think that you'll be in a very, very good place. So I hope this helps you guys, and I'll chat with you later. Bye.